Welcome everyone to Tax Power Hour. Today is August 2nd, 2017. This is our monthly webinar for August. Our today's topic is deferred compensation. We'll be talking about IRAs, 401ks, and pension plans. Today's content, we'll spend about 5 minutes real quick talking about the Tax Power Hour webinar series. Then we'll talk about why deferred compensation. We'll spend about 5 minutes talking about why is that even something that we think about or talk about when it comes to tax planning. Then we'll compare IRAs and Roth IRAs or individual retirement plans. Then we'll talk about 401ks for about 10 minutes or so. Then we'll bring in our guest speaker, Ralph, who will be talking about cash balance plans, defined benefit plans, and pension plans. And we'll spend a good 20 minutes on that because that's a very complex topic. And it is really kind of the pinnacle of tax planning when it comes to retirement plans and compensation plans, especially for high earning business owners. And then we'll spend about 5 to 10 minutes on Q&A. So it should be just under an hour. Maybe we'll get to an hour, but we don't want to get to an hour. We'll see. What is Tax Power Hour? We're a webinar series every month, all about small business and self-employed tax tips and tricks. We congregate or meet in these monthly webinars, although we record the webinars and post them to YouTube later. And some of our viewers like to watch them in YouTube, not watch them live, but we love for you to be here live. That way we can answer your live questions on the fly. We're working on the website, taxpowerhour.com, and we have an active Facebook group. Just search for Tax Power Hour, and then we're discussing tax topics in there. Now, this webinar series is the first Wednesday of every month. Sometimes they're 30 minutes long or 60 minutes long, somewhere in between. In special cases, we may have special episodes that are collaborated or sponsored with providers of the tax preparation industry or people that service small business owners that are concerned with tax in any way, shape, or form. We currently do not provide CPE. This is not a CPE based course. That gives me a little bit of openness to be able to talk about things that maybe I don't have to run past, a special protocol. And also I can give opinions about stuff if it's not a CPE. So that's why we make it a non-CPE. And typically we discuss about the discussions of tax law changes, practical examples, software, that sort of thing. About myself, I'm Hector Garcia. I'm a CPA. I am based out of Miami, Florida. We have an accounting technology and tax consulting, tax planning firm, and I'm also an advanced QuickBooks Pro advisor. I'm very involved in the community on QuickBooks related topics and then starting to get more and more involved in the tax preparer industry. Now, my email is hector@garciacpa.com. I'm pretty approachable. It's a good way to contact me if you have any questions about tax. Generally, I may give you an answer most likely with some sort of disclaimer, but I do give a lot of tax and QuickBooks type of answers via email. About our guests, we're gonna have Ralph Lindblom. He's a deferred compensation consultant at a company called Ingham Retirement Group. All they do is deal with deferred compensation on retirement plans, and they have CPAs on staff, so they really deal with the tax consequences about retirement plans. And his email's up on the screen and his phone number. He's really great to talk to. He usually answers the questions pretty well. So take a picture of the screen, keep that contact information if you have a question about a retirement plan. Ralph, let me unmute you real quick, just making sure that your audio is okay, and that you wanna say hi real quick.
Ralph Lindblom. I'm welcoming everybody to the presentation today. I'm always available for any general questions that you may have, or any specific questions that you may have as far as any of your clients for retirement plans. So feel free to reach out to me, and I look forward to doing the presentation later on. Thank you.
Thank you, Ralph. Short and sweet, kind of like the same way when we talk on the phone. It's kind of like that. Anyway, so he'll come in and talk about the cash balance stuff because that's stuff that I don't know about, and they manage really well. So, quick disclaimer surrounding Circular 230, specific sections around it. I cannot give you any electronic or written advice. The disclaimers don't talk about YouTube or webinars, but I assume it falls into the same mantle. So I cannot give any written electronic advice based on reasonable or factual assumptions or representations. So I'm making a blanket statement here that this is just talk. This is not authority. This is not tax law. This is a practitioner. Yes, I am a CPA, a practitioner talking about how I interpret the code and different areas of tax. Now, I can never give advice based on whether something is auditable and not auditable. So if you hear me say something about audit or audit risk, just completely disregard it for it to be actual legal advice, and make sure that you do seek an attorney if it's legal advice per se, and do seek a CPA in your area if for the actual tax advice. So none of this constitutes as tax advice, although we talk about hypothetical examples and how we approach them based again on hypothetical situations. You do definitely want to talk to your own CPA from your area for advice. If you need to hire me or you want to email me, my email is up in the screen. You can email me at hector@garciacpa.com or hector@taxpowerhour.com. I get both of those emails. Anyway, real quick, we're going to skip our September and October episodes because of tax season. I know we do got some tax preparers on the line that connect with us, and I'm a tax preparer myself, so I'm kind of busy. So we're going to skip September and October, and then we're going to come back in November, first Wednesday of November, to talk about international taxation. And I am going to bring another speaker that's an expert in the area for that. Then in December, we'll be talking about end of year tax planning tips. So we'll talk about kind of the common things that we talk about in November and December when it comes to tax planning, kind of low hanging fruit tax planning tips that people do towards the end of the year. And then we'll come back in January, and that says 2017. I really meant 2018 in there, sorry about that. And we'll talk about payroll taxes, 1099s, and if there are any significant changes for the 2017 tax season, I will discuss that. Anyway, let's get right into the topic. So why deferred compensation? Why is this something that we even discuss? Well, number one, the easy answer is, well, helping small business owners save for retirement. And that's nothing to do with tax. That just has to do with common sense. Yes, it makes sense to save for retirement or help someone to save for retirement. Now, there's also a really interesting thing is that generally speaking, in most states, retirement plans are protected from lawsuits and bankruptcy. I don't want to give legal advice. It may be different across in different states, but generally speaking, a retirement plan, especially if it's federally accepted like an IRA or a 401k, it's protected from lawsuits and bankruptcy. So it's also not just saving for retirement plan, it's also safeguarding those assets for retirement. Now, generally speaking, depending on the plan, and we'll discuss that, but the idea is that we take income that would otherwise be taxed today at today's rate with today's bracket, and defer it to some point in the future, over when you're over 60 or 70, whatever happens to be, and then hopefully in the future the tax rate is not significantly higher, or you're not in a significantly higher tax bracket. And that, generally speaking, that would be a good strategy, right? If you're not going to enjoy it today, save it, enjoy it later, and hopefully also you get a tax deduction today, pay the taxes later, but you're going to be in a smaller tax bracket. That's assuming that you retire not rich, but you retire okay. Now, there's also, in some cases, you have the concept of company matching. Now, in some cases, we hear company matching on the 401k, and this could be both to encourage an employee to stay in the company and to save for retirement, or to help a business owner get a little bit of tax deduction through the business by getting a little bit of matching from their own personal contribution. In other cases, there are things called profit sharing plans and deferred compensation, and that's the stuff that Ralph will get more deeper into, our guest speaker, when he talks about the combined defined benefit plans. And also in some cases, the idea behind the retirement plan, it's also that it grows tax free, so it kind of becomes like a little mini tax shelter. And then if you're putting money there for 20, 30, 40 years, and the money is being invested in the stock market, and we're assuming that there's capital gains, all those capital gains and all those benefits from investing in the company, dividends, all that stuff, they accumulate and they grow tax free. Now, there are some consequences in terms of paying the taxes once you take them out, and that all differs based on the plan that you're in. But that is kind of the concept. This is why we even talk about or discuss deferred compensation. Now let's talk about the easy, simple one. This is the one that everyone automatically has access to, and for the most part, it is not an additional cost to the individual, or the costs are minimal. It's called an IRA, an individual retirement account. And there's two types. One is called the traditional, and the other one is called the Roth. And we'll discuss those in detail. Let's talk about the general concepts that are for both. Number one is it's an individual retirement plan. It's not jointly held. It's only owned by the individual. Yes, it could be passed down if there's in the event of death or state or inheritance. It could be passed down, so that's not a problem. It's typically not employer sponsored. That means that the person goes out on their own accord and they take it. You must have taxable compensation from non-passive sources. So typically passive income like real estate, certain type of royalties, other retirement income, that sort of stuff is not income we can put as deferred compensation in an IRA. As of this year, 2017, every individual that's under 50 years old can put $5,500 per year. Married filing jointly, that would be 11,000, 5,500 each. But both must have income, both must have taxable compensation if you want both spouses to put money in the retirement plan. And for anyone that's 50 years or older, they can do what's called a catch up. They can put an extra $1,000 in there, and then it becomes 6,500, the annual contribution they can put in. Now, the point of putting money in an IRA is that you put it in, you tuck it away, and then it reduces from your taxable income. This is why you must have compensation. Otherwise, you can't. There's no reason to to get a tax deduction because you had no income to pay taxes on, and you can put up to 100% of your compensation. So if you make $5,500 for the whole year, you can put the entire thing in your retirement plan. If you make $3,000, then that's the maximum you can put in your retirement plan. And then they grow or accumulate tax free. That means you don't pay capital gains, dividend tax as those, because typically IRAs are investments in the stock market. Or not always the case, but it's typically where people put the investment in. So all those ongoing benefits that you would otherwise pay taxes on, that in contrast of a regular investment into a mutual fund or whatever, those you typically pay taxes as you earn them. With IRAs, they grow and accumulate tax free. Now, let's talk about the traditional IRA specifically. This is the one that most people use. This is the one that gives you the tax benefit when you contribute to it. Number one, past 70 and a half years old, you cannot contribute anymore to it. So, at any age that you're earning income, you can contribute to your IRA. Up to 70 and a half years old, cannot contribute anymore. You can start withdrawing money at 59 and a half or older. So you can start taking cash against it. You can take the whole thing or you can take some of it, and it will be penalty free. And we'll talk about the specific early withdrawal penalty in a second. You can make contributions throughout the year or up to April 15th or whatever the tax day is, if it gets pushed to the 18th or 17th, whatever, up to the tax deadline of your regular tax return. You can contribute up to the April 15th. That's why a lot of people between like April 10th and April 15th rush out and open investment accounts in Schwab or Merrill Lynch or whatever, because they want to start an IRA account, because most tax preparers or CPAs recommend them to do so because it does give you some immediate tax savings. And it's disallowed if you're already covered under some sort of employer sponsored plan. So if you have a pension plan or a 401k in which you're already deferring income, you cannot use the IRA. So the IRA is there, or the IRA is there for every person that on the US that does not have access to an employer sponsored plan, that wants to defer some of the income, put it in a retirement plan, and possibly get some tax savings. And then the most important thing about the IRA is that all distributions are taxable. So you get a tax break or a tax reduction, a reduction of your taxable income once you contribute, but then once you take them out, they're taxable. The logic behind this is that hopefully, that when you retire, the tax rate will be lower and you'll be at a lower tax bracket because you're retired and your only source of income will be your distributions from your IRA. Okay. Other points about the traditional IRA: deductions phase out at 62,000 for single and 99,000 for married filing jointly. So the benefit of the traditional IRA, it's really more for the lower income earner. So you have anyone that makes $250,000, whatever, the IRA no longer adds any value to it because you could put money in it, but you don't get a deduction. So what's the point? You cannot borrow from it. Okay, you cannot use it as a security for a loan. You cannot buy personal property with it. All these events, right, whether borrowing money from it or using it to secure a loan or buying personal property from it, that would be considered as a taxable distribution. It would be the same thing as you just taking the money out. Now, something really, really important about the traditional IRA: after you're 70 and a half years old, you must take what's called a required minimum distribution. And that's not an exact science. You actually have to go into the IRS website and pull up the schedule. It has to do with, the mortality rates and, the rate in which you should be taking the money out and enjoying it. Otherwise, if you don't take the required minimum distributions, there's a 6% penalty on that amount that you didn't take out every year. So you definitely don't want to keep your money in your traditional IRA after you're 70 and a half years old, because you're going to start getting a penalty for not taking the required minimum distribution. This is the big one: 10% penalty for early withdrawal. So if you put money in your IRA and you take an early withdrawal because you need the money, whatever, before you're 59 and a half years old, you get a 10% penalty, plus you pay your taxes for the distribution. So you pay taxes for the income that you took out, because obviously you took out a deduction when you put it in there, but you're going to pay those taxes plus a 10% penalty. There's a few exceptions to the 10% penalty. I'm going to cover the most common ones. I mean, there are more than this, by the way. These are not all of them, but you can take a one-time lifetime early withdrawal to purchase your first house of $10,000. You can take $10,000, will be a first-time home buyer exception that will not get the 10% penalty, but yes, you will pay the income taxes on the distribution because, again, you took a deduction when you first put the money in. For reimbursed medical expenses, these are medically required medical expenses. So no Botox or no breast augmentation or whatever. For required medical expenses, you can take the money out, and only for the portion above 10% of AGI. So the same medical expenses that you could take as a deduction in your Schedule A, you could take them from your IRA and not get that 10% penalty. Again, if you take the withdrawal, you still pay the taxes on it, but not pay the 10% penalty. Now, if you're deemed totally disabled, you can take the money out, no penalty, still pay the income taxes, of course. And for qualified higher educational expenses, so this is for going to college and not for, the room and board and stuff. This is for the actual tuition expenses. Okay, Roth IRA. So there are some similarities from the IRA and the Roth. So the contribution limits are the same, the 5,500 and the 6,500 we talked about. The limit is combined. So if you want to open two, a Roth IRA and a regular IRA, the combined limit applies. So you can put up to 5,500 or 6,500 if you're over 50, combining both. Now the income requirements are a little bit higher. So if you make a little bit more, you can still put money in the IRA. Notice that the phase out starts at 118,000 for single and 186 for married filing jointly. Now there are no required minimum distributions on the Roth IRA, so that's a benefit. And the same 10% withdrawal applies, but there are some exceptions, so we can discuss those. Now, Roth IRA needs to be vested for 5 years. That means that you need the money has to be there for 5 years before you can take distributions out. This is even if you pass the 59 and a half years old. So if you start at 54 years old, then that's fine. Once you hit 55 and a half, you're good. But if you start late in the game, you have to wait until the 5-minute vesting period passes by before you can take the distributions. Now, distributions are not taxable. That means that when you take money out of your Roth IRA, you do not pay income taxes for that earned income. At the same token, contributions do not reduce tax. So the Roth IRA, it is not a truly a tax deferment strategy, because when you put money in the Roth IRA, you do not get a tax benefit for putting it in, for contributing to it. So this is solely used to put money in your retirement plan for the other potential legal reasons, and also as we spoke earlier, for it to earn and grow tax free. Okay, let me stop for a second and let me take in some questions. Let me see what we got in our questions box. Let me see what we got here. Okay, are are the exceptions noted with code in Form 1099-R? So Susan is asking that possibly because she was working on a tax return and she saw a Form 1099-R, and that's the official form in which the banks or financial institutions report a distribution. So her question is, are the exceptions noted? So in some cases, the financial institutions are notified ahead of time that the distributions themselves fall into some sort of exception, and then they report it for you, but they're not required to report the exception. The exception is the burden of the taxpayer. So the taxpayer still has to prove that, that exception applies. Now, another question we have here from Fawcett: can you do both a Roth IRA along with an employer sponsor plan? So as I mentioned earlier, no, you cannot combine them. So if you have a 401k already and you're putting whatever $10,000 in your 401k, you can't do a Roth IRA in addition to that. And then Carol says, can you please explain the combined limit? So what I meant by that is, again, let's say it's a single person under 50, the limit of IRA is 5,500. So if they have both an IRA, a traditional IRA, and a Roth, both combined amounts cannot add up more than 5,500. So that's what combined limit means. It means that either a Roth IRA or a traditional IRA, whichever way you go with, if you happen to combine them, the limit is the same for both when they're combined. So Carol, hopefully that answered that question. Okay, so let's talk about the 401k. Now 401k, it's something I really, really like, I really, really enjoy, because it's employer sponsored. So a 401k not only is great because it's kind of like an IRA with much higher limits, it's also something that the employer can encourage their employees to use. And generally speaking, because a 401k sometimes can have additional benefits, such as employer matching, and we'll discuss that in a second, it tends to be what we call in banking, we used to call a sticky product. It's a reason for the employee not to leave. Like some people actually think, oh man, if I take that job somewhere else that pays me, $3 an hour more, whatever it happens to be, I gotta move my 401k, I have to distribute it, I have to turn it into an IRA, whatever. And in some cases, I mean, I know it's very faint, but in some cases, having a 401k could increase retention rate. I haven't read of a study in which proves it otherwise, but I am sure that companies that have 401k plans have higher retention rates than companies that don't. Now the contribution limits are increased big time. So if you're an individual person under 50, you can put up to $18,000 per year. And if you're 50 years old or more, that goes all the way up to 24,000. So there's an extra $6,000 that you can contribute if you're under 50. And again, contributing to a 401k reduces your taxable income, your income taxes, right, on the year that you contribute. Same 10% distribution penalty applies if you distribute before 59 and a half years old, and the same required minimum distributions at 70 and a half years old. 401k, by the way, it's pretty much like an IRA at the end of the day, especially because once you retire from work, that's what they end up turning into. They turn into an IRA. That is the typical, what they call the rollover. When you quit a job or you get terminated, your 401k gets moved into an IRA and you don't pay any penalties because you're not distributing the money, you're just rolling it over. So that's typically what what it is. Um, Okay, let's see. Somebody here saying that I believe you can contribute both to a 401k and a Roth IRA at the same time, and they send me a link. So I'll go ahead and confirm that real quick. That question hasn't come up. So combining a Roth IRA and a 401k, I could be mistaken, and that's totally okay. I am not. Particularly worried about making a mistake. If I make a mistake, I did. So someone in the live chat is saying that yes, it is possible to combine a Roth IRA with a 401k. However, I am not confirming that, and I don't know if I'll have a chance to confirm it. I would have to literally read tax code while while Ralph does the presentation. And if he happens to know, he'll clarify for me too, because he does this stuff all day long. Now, employers matching is really nice. So employers can match what's called up to the contribution limit. So for example, if an employee puts $9,000 in their 401k, that it's money coming out from their compensation, an employer can offer as a benefit to match it, to go all the way up to 100% of what the employee puts and put an additional $9,000. This is a way an employer can give an employee a bonus without it being taxable, but it goes straight into their 401k. Now, in order to do matching, it can be discriminatory. So it needs to be something that has a clear vesting period. It has to have a clear percentage, meritocratic way in which percentages are increases. You can't just give one employee 100% matching and another one if it's discriminatory. So that's general rule for most retirement plans. That's the case, and Ralph will talk about that quite a bit. Now, there's on top of the 401k matching, employers can also combine them with a deferred compensation plan in which an employer can contribute an additional $36,000 that gets deferred into a pension plan. So you can combine both the 401k plus the deferred compensation plan that the employer puts in. Again, this would be kind of like a profit sharing deferred compensation the employer puts. So combined, it's $60,000 for a person over 50, or 54,000 for a person under 50. Okay, let me see what else we got here on the 401k plans. Okay, so another interesting thing is a 401k plan allows you to borrow against it. You can borrow up to $50,000, but it cannot be more than 50% of its balance. So if you have at least $100,000 in your 401k, you can take up to $50,000 as a loan, but you must repay it within 5 years. That's the key. You must repay it within 5 years. Now, there is no quote unquote first time home buyer exception. So if you take $10,000 out of your 401k to buy a house, it's still going to be early payment, early distribution penalty if you take it before you're 59 and a half, but you could borrow against it. So that's kind of like the good thing, that you don't have that exception, but you can borrow against it. And like I said, typically that gets rolled over into a traditional IRA when you retire from it. Now, other plans that, for the sake of time, we're not going to be able to cover, but they're at least good for you to start googling, search them out to see what else is out there. There's something called a simple IRA, which is kind of like an IRA that's also partially set up like that, but it has higher contribution limits. There are some other restrictions around that. Contribution limits go up to 12,500 and 15,500 for over 50. So you may want to read up into that. There's also something called a SEP, a self-employed pension plan, and a SEP IRA. So you want to check those out. As I mentioned earlier, the combination between deferred compensation and 401k, it's 54,000 or 60,000. So the SEP pension combined would also fall into that same dollar value. And there's things like the 457b, 403b pension plans, depending on what type of company you're working with, you can do that. So those are things worth it for you to search, but we're not going to get into too much detail because we are going to talk about the defined benefit plan. All right, real quick before I jump and pass over the baton to Ralph, let me see what else we have here. So what benefits does the employer get for their part? So James, the benefit an employer can have for matching, it's retention, right? That's it. Or attractiveness, like a company could be more attractive to work for if it has a 401k matching. And that's really it. Does a simple IRA have a vesting period? So, Susan, I'm not going to talk about simple IRAs because we didn't allocate the time for that. But that's a good question. Maybe I'll email you directly. We talk all the time via email. Can an employer match the 50 plus portion? So, Edwin, yes, an employer can match up to the contribution amount. So the combined amount between, we're talking about 401k now, of what the employee contributes and the employer or the company contributes cannot go over that 18,000 or 24,000 amount. So yes, an employer can match up to that 24,000 as long as they're over 50. Let's see. So the match in the 401k is non-taxable for the employer and for the employee. So Julie, the portion that the company matches, it's a deduction for the company. It's a deduction. It comes out of their taxable income. It's money coming out and being paid to the employee, and it's not taxable income to the employee. So yes, it's actually a tax benefit to do the matching. Let's see what else we have here. More expenses than actual benefits, which reduces taxable income tax savings. Not sure what Michelle meant by that. Michelle, maybe you want to reword that, and I'll add some notes to that. Okay, let me minimize this screen and let me open up, do a full screen on Ralph's presentation on a cash balance plan. And let me zoom this in. I think you should be able to see. Okay. Let me just make sure I can move the slides. Yes, I can. All right, perfect. So let me unmute Ralph. And Ralph, you're on, so you can start. Just let me know when you want to pass the slides.
All right. Thank you, Hector. Welcome, everybody. I wanted to address a couple of questions that came up. The first one is on the Roth IRA income eligibility. Under the current regs, a single head of household must earn less than $118,000 to fully contribute to a Roth. Married filing jointly or qualified widower, the income level is $186,000. Those income levels are dropped or lowered as a individual is covered by a retirement plan. So if somebody is covered by a retirement plan, those income levels are lower, and Hector already showed those income levels.
So just to get clarification on that, so you can't combine a 401k or some other employer sponsor with a Roth IRA, but that will be reduced proportionally by the benefit you're already getting on the other side. Is that what you're saying?
Well, what I'm saying is, as long as the income level that somebody earns is less than the dollar amount that you showed on your other slide, then they can combine it. But so what happens is any business owner that has a salary over that, there's a phase out that normally happens over like a $10,000 limit. So typically any business owner that's covered by a retirement plan typically would not be eligible for the Roth IRA.
So I stand corrected. You cannot combine it with a traditional IRA, but yes, you can combine it with a Roth IRA, correct?
You can combine it with both a traditional and a Roth IRA, all dependent on two items. One item is whether you're covered by a retirement plan, and second, the key item is the income of the business owner. So if the individual is covered by a retirement plan and has income lower than the threshold that you showed, they can get a deduction on both sides. If the income is substantially higher than what you showed, Hector, they cannot get a deduction. So it all ties to the income level of the owner.
Got it. Thanks.
The second item is Hector did go through the age 70.5 distributions, minimum distributions, and as well as the taxation. Two items, as far as retirement plans go, as long as you're an active employee, if you are not a 5% owner, then the 70.5 distributions do not have to be made. So any rank and file employees in a retirement plan that's not a 5% owner, there is no minimum distributions. So we have people that work in the 70s or later that they're not required to do distributions until they terminate employment or retire. For business owners, obviously, you do have to do that 70.5 distribution. The other item that Hector had shown is that the IRA contributions stop for people that are over age 70.5. In a retirement plan, it does not stop. So if you have a business owner that's over age 70 and a half, that business owner can continue to make salary deferral contributions into a 401k plan, no matter what the age of that person is. So additional money could go into the plan, but yet with the business owner, some of that money is coming out. But that availability is still there in the retirement plans. It is not there in IRAs. And I'll go through any questions at the end of the presentation. But myself, I've been in the business for about 40 years. I've been about for 15 to 20 years here in Ingham Retirement Group. I'm a plan consultant. I have a master's in accountancy, so I'm very well versed with the taxation and help accountants all along. And our firm is also a registered investment advisory firm, and I'm an investment advisor too. So we do both the administration and the investments on retirement plans. So we can help on either way. And I'm always available to help on any tax questions or any questions that you may have on any of your clients or prospects as it pertains to retirement plans. What I'm going to be talking about today is Hector did a very, very good job on IRAs and the basics of 401ks. The issue that happens a lot of times with business owners is by putting in either 5,500 or 6,500 in IRAs, or 16,000 or 54,000 in 401k plans. A lot of times that does not provide sufficient income level for a business owner that wants to retire, especially for business owners that are within 10 years of retirement. So even if they're maxing out the 401k at $60,000 each, and they end up with $600,000 to $700,000 after 10 years, a lot of times that money is not sufficient to provide the level of income that the business owner wants. So generally what happens is when you have a situation like that, the best type of retirement plans are called defined benefit, and there's a variant of that of a cash balance plan. So we're going to go through that a little bit. So we'll go to the next slide, Hector. Hector, can you switch to the next slide?
To the one that says well-designed 401k, or the next one?
Then just the next slide after cash balance plan case study.
Okay, so I got, can you see my screen though? I want to make sure you can see my screen.
The only thing I see on your screen that says cash balance plan case study.
Okay, hang on a second. Let me just make sure that it should say screen. Give me 1 second. So there's screen 2. Okay, so you should be seeing not case study, you should be seeing well-designed 401k profit sharing plan. Is that what you see?
No.
Hang on a second. How about now?
There we go.
Okay.
Mm-hmm.
Go ahead.
Perfect. All right. So one of the key items is there's very differences on the design of a 401k plan. So for your clients, you want to make sure that a 401k plan that they adopt is extremely well designed. I.e., what happens is most small business owners, they want to try to maximize their contributions. And if we're talking about a very, very small business owner, typically to minimize the cost for the employees. As you get a business owner that has 50 or 100 employees, it's more of a retirement plan. But for the very, very small business owners that have 10 employees or less, the tax situation becomes overriding on why they should do that. So as Hector had mentioned in the first point, somebody can contribute $18,000 if they're younger than age 50 or $6,000 more. There's a profit sharing / match that can go up to $36,000 a year, and Hector mentioned that. They receive the vested benefits of balance out of retirement or termination, i.e., you typically can have what's called a 6-year graded vesting schedule. So if somebody works for you for 2 years, they may get 20% of that money that the company puts in. Then it would be 40% in year 3, 60%. So it goes 0, 20, 40, 60, 80, 100. As Hector said, it's an enticement to keep the employees employed at your firm and not jumping from one firm to another. The participants take on the investment risk, so the employer is not guaranteeing the investments. And as Hector had mentioned before, the limitations is either 54,000 or 60,000. So we'll go to the next slide now. All right. So as I mentioned, that $54,000 or $60,000 a lot of times does not provide enough income for the individuals. So what happens is when we look at current 401k plans, we typically add what's called a cash balance plan that provides significant guaranteed retirement benefits and savings opportunities for the partners. And a cash balance contribution allocation can go all the way up to a limit of over $200,000 at age 58 if the business owner is making 200 or 210. So the dollar limit that you're looking at as far as contributions is very significant versus a 401k plan. Okay. As opposed to a 401k profit sharing, investments earnings in a cash balance plans are predetermined, typically at a 5% rate. So each year, no matter what the investments are doing, you're crediting a 5% return on the employee's account balance. So therefore, the returns are guaranteed and the employer is taking the investment at risk. Okay, we'll go to the next slide. Each participant receives an annual allocation, which is the contribution plus the guaranteed interest rates. You need an enrolled actuary to certify the funding of the plan, and Ingham has a actuary on staff. And assets are generally invested to meet the targeted rate of return, as I said, about 5%. If assets fail to earn that, then what happens is an additional deductible contributions may be required by the employer, i.e., the employer may need to put in additional money to get the balances back up to the guaranteed amounts. Okay, next slide. To maintain IRS qualification standards, the plan's benefit and allocation formulas should be in place for at least 3 years. At termination and retirement, participant account balances are paid as a lump sum, and as Hector had mentioned, typically rolled over to an IRA account. At termination, account balances can be rolled over to the 401k plan, and partners owners can resume maximum 401k contributions. And plans are subject to a government agency, which is called PBGC, for all except for very small professional groups. Okay, next slide, please. All right. So as I mentioned, partners can receive a much higher contribution. Properly designed cash balance plans allocate the majority of the contributions towards the partners, i.e., the reason why you're doing this is two things. One is to get very large contributions to the owners, and the second is to get that very large tax deduction. And you want to make sure that almost all of that money is being allocated to the owners themselves. Okay. Unlike traditional defined benefit plans, older employees do not drive up cost. So typically what happens is if you have a small regular defined benefit plan and it hires a middle-aged person, say in their 40s or 50s, the cost of that employee as far as the contributions can be pretty significant. The cash balance plans look at the average age of everybody in the plan, so it drives down the cost for that older employee. And we say that a lot in doctor's office, where the office manager may be in the 50s and the other staff are typically in the 20s or 30s. Okay, next slide, please.
And Ralph, you allow me to give a little bit of context here. Just want to just real quick before you get into the numbers. The context
Okay.
is the following. If you are a business owner and you're the only employee of that business, or you and your wife, spouse, whatever it happens to be, anything that goes into a retirement plan, it's in essence 100% your benefit. So the tax savings are 100% going into your pocket. What Ralph is talking about, it's companies are maybe a little bit bigger and have employees as well, and you cannot have this concept in which the business owner employees get all the tax benefits of putting money in the retirement plan and the employees do not. As somebody asked earlier, what is the benefit of an employer to offer a retirement plan? And I mentioned earlier, this potentially subjective terms like, well, retention or attracting talent. But what Ralph is talking about, actually a plan that actually allows to maximize the tax benefit of the business owners or the partners, while not having a discriminative plan that also involves the employees or the staff but reduces the cost of the company, because you have to involve everyone in your pension plan, but it reduces the cost of the company with this very specific tax strategy. So sorry, Ralph, I just wanted to give you that context because it seems I'm in the field talking to people that's the type of stuff that resonates most of the time.
Yeah, no, that's perfect. The 401, a typical 401k plan, an employee that's looking for a job, they would want the company to have a 401k plan. So most companies will absolutely have to have a 401k plan and maybe a small match to entice employees to join on with the firm. A cash balance plan is just the difference. What you're trying to do is you're trying to maximize the contribution to the owners for cash accumulation and retirement, and trying to get a very high level of tax deduction. So if you have an individual or corporate tax payer that's in a 35 or 40% tax bracket and is paying, say, 40% on taxes, you want to have a retirement plan that more than 60% of that money goes to the business owners. And the more that you could go for, as far as the higher the percentage, the better it is going to be for the business owners. So it's a different kind of philosophy on a traditional 401k plan versus adding a cash balance plan. And in this example, what we did is this is a typical law firm. You can see that there's 4 senior partners, there's 4 associates, and there's about 13 staff people. And they all varies in age from the owners as well as the employees. So you can see all the partners are making over 270,000. The associates are making between 125 and 140, and the staff is making anywhere between 25 and 55,000. So we'll go to the next slide now.
And that's a typical scenario in a kind of a mid-size type of accounting firm. But this is not just for accounting firms. This could be for an engineering firm. We have a client that we work in common, which is an engineering firm that has a very similar setup like this. So
Yeah. So generally, what happens is in a 401k plan, you typically would have 2 different levels of contribution. One was the 401k salary deferrals, i.e., how much somebody takes out of their own pocket to contribute. And then the second is employer contributions. So the first step is, as Hector had mentioned, the employee can defer either 16,000, 18,000, or 24,000. So in this example, you could see under the 401k deferral, all partners who are over age 50, they're all putting in 24,000 out of their own paycheck, and then each employee can put in whatever they want. Now, the second aspect is, as Hector had mentioned, matching or profit sharing contributions. And this is where the small business owners typically want to try to maximize their contributions and minimize the cost for the employees. So you can see in this example, we use what's called a cross-tested methodology that's allowed, and it's subject to discrimination testing. But you can see that the 4 employer contribution of $36,000. We've limited the associates to 3% of pay, and we limited the staff to 4.44, which is 1/3 the percent that the owners get. And there's a certain discrimination test that needs to be done under Code Section 41A4, and this plan passes. So you can see that the business owner is getting 3 times the level of contributions for the staff as a percentage of pay, and they're getting more than 4 times the level of contribution for the associates. So it's a very generous plan for the business owners. We'll go to the next slide now. Now what happens is we say, okay, the business owners say, it's great that I'm getting $60,000 a year, but I want to retire within 5 to 10 years, and I want to put in a lot more contributions. How much can I contribute? Well, here's a slide now that we've added the cash balance contribution on the left-hand side next to the salaries, and you can see the cash balance contribution. starts at about $155,000 for a partner that's age 51 and goes up to a contribution of $220,000 for somebody who's age 61. So we typically have these plans run for a 5 to 10 year period. We've given no contributions to the staff, to the associates under the cash balance plan, and we've given a contribution to the staff necessary to pass the discrimination test. So all the way on the right-hand side, you can see percentage of pay. The 4 business owners are getting contributions into the 2 plans of anywhere between 71 to 95% of their pay. The employees, the associates, are getting 3% contribution, and the employees to pass discrimination testing are typically getting anywhere between 8.5% to 9% of contribution. So we've increased the total contribution to the partners to over $1 million, and the contribution to the staff is $59,000, i.e., about 95% of the money is going to the business owners. So we can go to the next slide.
And if you also allow me to add some context here. So basically what this plan allowed the partners to do is to take $1 million of deferred compensation, which is a tax deduction to the corporation and is not something that pays taxes immediately. None of the partners pay taxes immediately. That goes to the retirement plan, and they'll pay taxes when they take it out, etc., etc. And you only paid out of pocket $59,000 of contributions to the employers. That $59,000 is a real out of pocket cost. So the company is paying out $59,000 for the employees' contribution plan, retirement plans. So yes, this has a real hard cost of about 10%. It looks like it's about 10% of the employee's salary, a real hard cost to have. But the idea is, and I'm sure you're going to show it in the next slide, so I don't want to spoil it, is that $1 million that you're deferring, that the tax bracket that you're going to be at currently, let's say 30%, whatever happens to be, that's $300,000 in taxes you save right away. So that real $59,000 cost, which is a benefit to the employees only, not to the owners, could potentially also be a humongous tax benefit to the business owners. And Ralph will correct me if I'm wrong in the way I explained that.
Yeah, that's correct, because what happens is under these combined plans, you have on the far right, here's a summary of the 401k by itself on the left-hand side, and the combined plans on the right-hand side. So the summary is right below that. Under the 401k, you had the owners were getting $240,000. Associate cost was $15,900. Staff cost $21,000. So the total contribution was $277,000. I.e., as Hector said, if you had a business owner that was in the 30% tax bracket, they would save 30% of that $277,000, which is $83,000, and they're only funding $37,000 to the associates and staff. So the cost for the associate and staff is being funded by the IRS by the lack of taxes that you're paying. Adding a cash balance plan, you can see we're adding an extra $776,000 to the 4 business owners. It's only costing $21,000. So we're adding almost $800,000 of additional contribution. Once again, if the business owner is in the 30% tax bracket, that's a savings of $240,000. $21,000 is going to pay pay the staff cost, and the other $220,000 is a savings for the business owner. So you can see the percent of the contributions going to the owners. Originally under the 401k plan, it was about 86.6. Now to the cash balance plan, it's 97% of the additional money. And what you did is under the total plans, you've increased the percent going to the owners from 86.6 to 94.5. And the next slide is just a pie chart of the numbers for people that like graphic. As you can see, the difference in the contributions from a 401k plan, what an additional cash balance plan could be, and then what the total results would be on the right-hand side. So the key aspects and the benefits of it, as we mentioned, is the best of accumulation of cash at retirement. It's the you get a tax deduction of the money. So business owners want the tax reductions, and it's credit approved, as Hector said.
Thank you so much. And we're almost at top of the hour, Ralph. So I'm running a polling question real quick just to kind of get a quick gauge of the people that are attending live, kind of what the relationship is with their clients. And they were asking me some questions. I don't know if we'll be able to answer them quickly. Is this significantly different than a self-employed pension than a SEP?
A SEP plan is like a 401k, so the limitation is still $60,000. Cash balance plan, as you can see, can contribute up to 200,000.
Okay. Another question is, where does the money get invested? Is this in the stock market, or does it have to be invested in any specific vehicles?
The business owner is typically what's called the trustee of the plan, which means that they have the fiduciary responsibility to invest it, i.e., they can invest it anywhere that they want as long as it's allowed by the IRS.
Even
So
if
it could be
it's
stocks,
even if it's high
stocks,
risk,
mutual.
even if it's high
Yes,
risk. Okay.
it could be stocks, bonds, CDs, however they want to invest it. The only thing is you can't invest in what's called a prohibited transaction, i.e., buy a piece of real estate that you live in. But you could always buy rental properties that you and your associates don't live in, and you're using that for income.
Sure. Another question here that I'm not sure if you can answer this completely, but and there's a polling question in the screen if you don't mind answering it. Um, are these expensive to set up and maintain?
The cash balance plan, you're looking at a typical plan document of $3,500. The annual administration is $5,000 plus $100 a person.
Now, the
So it's much.
follow up question to that,
It's
Ralph, is
yeah,
why are those fees particularly high? I mean, what's the what are the requirements that you have to do in terms of documentation and all that stuff?
right. The first thing is you need a custom legal document. Second is that you have to combine the contributions on the 401k with the contributions on the cash balance. And then the third item is that there's various different discrimination tests that you have to use, and then it needs to be certified by an enrolled actuary. So it's definitely higher expenses. It's not somebody that only wants to put in $20,000 or $30,000. It's typically used for a business owner that wants to put in an extra $50,000 to $100,000.
So you're saying is if for this type of stuff to ring the bell, it would be someone that's already making in terms of profit or whatever already over $100,000, and they want to put away at least $50,000 every year. That's what you're saying.
It, it would be for somebody who's already in a 401k plan, maxing out their salary deferrals and the employer contribution, which is $60,000, and is still being hit with significant taxes and wants to put in at least $50,000 to $100,000 more than the $60,000 they're putting in a 401k plan.
Okay, so if they're only putting up to the 401k's limitation, and that's it, that's how much they can afford to put in the retirement, then your blanket recommendation is you're probably better off just just doing the 401k and that's it.
That's correct.
Okay, perfect. Anything else you want to add before we wrap up? I put your email and your phone number on the screen. I just want to add that this guy, it's a wealth of knowledge. He's really, really good at. I mean, he won't do technical support on your retirement plan stuff, but he'll answer really important questions about limitations, and some of the certain requirements around setting up retirement plans. So we use him. We recommend Ralph and his team, Mark, to our clients that want to put away money. So, open. He's an open book. There's his email. There's the phone number. Do you want to add something else?
Yes, the only other thing I would add is two things. One is I am open, so any questions you may have, be glad to do. Second is we do proposals. So if you have a client census that you want to run our way, we'd be glad to custom design a retirement plan that meets the goals and objectives of your client.
And no cost on those proposals.
No cost for the proposal.
Perfect, Ralph. Well, thank you very much. Let's talk about real quick about other webinars that I'm involved in. We'll have a webinar in about 1 hour, so I'll have just enough time to have lunch. So we'll have in an hour a webinar called Deep Dive into Pivot Tables. Just Didn't have a chance to update the slides there. So deep dive into pivot tables. That's at 2 o'clock Eastern in 1 hour. excelpowerhour.com to join that. And then next Thursday, you can join if you're not already part of it. QB Power Hour, which is QuickBooks tips for QuickBooks Power users, and you can join that at qbpowerhour.com. That's every other Thursday, starting next Thursday. And then Enterprise Expert on Wednesday, 8/16, we'll be doing a deep dive into time tracking for QuickBooks Enterprise. Thank you very much for joining us. Stay connected. Join our Facebook group. Email me, email Ralph if you have any questions. Have a wonderful day.